Time for the Fed to start cutting interest rates. That's exactly what happened today. I'm recording this podcast a few days prior to when it's published, and the Fed just cut rates as expected by a quarter of a percentage point, and they're talking about forecasting that they're going to continue on that path at least for the next couple of months. So what does that mean for investors? What does it mean for retirees? What does it mean for you if you're getting close to retirement? Now, the situation in the economy is it's not great. The economy isn't in great shape right now, and the Fed is really in a tough spot because just last week you had jobless claims that jumped to their highest level in nearly 4 years. That's a clear sign that the labor market is weakening. This really matters for a couple of reasons. One of which, if you go back and you look at pretty much any prior recession, the jobs market is really one of the last, or at least one of the later dominoes to fall. So if you go back to '08 and you look at the recession and overlay the recession on what happened with initial jobless claims, what you find is that the recession starts and you start to see this creep up in unemployment rate, not too bad. And then it really takes off. It's like a hockey stick straight up. And it peaks. In fact, in '08, '09, it peaked after the recession was over. So it starts later and then ends later, and then it goes back dramatically down once the recession is over and things start growing again. But regardless, if you're talking about a recession, doesn't matter what recession you look at. In the early 2000s, same thing. In the 90s, same thing. The 80s, whatever recession you're looking at, the jobs is one of the last dominoes to fall. So we have this grim sign in that the jobless claims are jumping. We had that huge revision from the Bureau of Labor Statistics showing the US added 911,000 fewer jobs than what was originally reported in the year ending in March of 2025. So from the spring of 2024 to the spring of 2025, about 1 million less jobs than we thought existed. That's bad news. Bad news, a bad trend for the job situation. So recently, the Fed has showed that it's going to prioritize the job situation because it has basically a dual mandate. One is to keep inflation at bay. Track record recently, not great at that. The other one is to maintain a healthy labor market. So they tried to balance doing those things by their bond buying or selling, and then also the raising and the lowering of interest rates. So inflation is a more manageable level right now. It's a little over 3%. I think the last reading was 3.1%. Their target, the Fed's target for inflation is 2%. So if they're prioritizing inflation, they're saying, look, we're not there yet. We're going to keep interest rates higher. But what's happening in the job situation is taking precedence over the concerns about inflation. And so they're in this really sticky situation. You have tariffs that are still on the horizon that could drive costs higher later this year. Even without tariffs in the picture, just the decision by the Fed to cut interest rates is a little risky when you're looking at it through the lens of inflation. So they're really walking on this tightrope. They're trying to support the job market, but we want to avoid stagflation, which is a real concern, especially right now with the signs of the economy slowing down. Even though the stock market continues to grow, and there are certainly signs that many businesses are doing okay, especially the large publicly traded companies that are reflected in the stock market, the average American is not doing well financially. You see that in the housing market, the unaffordability. You see that with inflation and spending. You see that with consumer confidence, which is a very interesting benchmark when looking at the average American and how they're doing. And then when you consider that the consumer spending makes up roughly 2/3 of the economy, that's not something that is sustainable. So I think we're on this concerning path. I'm not sitting here saying that we're going to go into a deep, dark recession that's going to rival the global financial crisis of '08 and '09. I'm not saying that. But what I am saying is that the dominoes are starting to fall and the Fed needs to act. But again, they're in this really tough spot. So I want to talk this week about why you should care about this. A small rate cut isn't going to have a huge impact on the stock market or the bond market. But rate cuts do ripple through the entire financial system. They affect everything from your savings to your bonds, your stock portfolio, real estate, even gold. So, I want to look at what this means for different parts of your portfolio this week. What can you do about it as an investor? How is that going to impact you? But first, if you're new to the podcast, a little bit about me. My name is Ashley Michike, and I'm a financial advisor. I'm also the co owner of True North Retirement Advisors, a fee only fiduciary advisory practice currently managing about $450 million in client assets. And for the last 18 years, I've worked with my clients, helping them retire with confidence. And my goal on this podcast is I turn all the complexities of planning your retirement into clear answers so you can spend less time worrying about running out of money and more time enjoying your retirement. So thank you so much for joining me this week. I'm exploring some different formats for the show. Normally, this is a daily short form podcast, but this week and in subsequent weeks, I'm going to kind of trade off, or some weeks I'm going to do just one episode like this week. Other weeks, I'm going to do the daily episode. So if you know somebody who's interested in this topic, be sure to share the show. But if you're a longtime listener and you're like, why do I keep having weekly episodes instead of daily episodes? I'm just experimenting and trying to figure out what's going to work best for this podcast going forward. By the way, if you have feedback about this, if you're a daily listener and you're like, I don't like this, go back to the daily. Or if you're like, I like this, I'll still continue to listen, even if it's a less frequent publishing schedule and a bit longer episodes. I want to know what you think. So let's get into it. Now, I want to start briefly by just setting up the context here and explaining what interest rate cuts by the Federal Reserve actually do, how that impacts interest rates and inflation. So I talked about the tools in the Fed's toolbox. They can basically buy and sell bonds, and they can change the interest rate, but they only have control over one specific interest rate, and it's a very short-term overnight rate. So if you're looking at how that is going to impact mortgage rates or CDs, credit card loans, car loans, etc., the Fed doesn't directly control those rates, but it does trickle through the system. So when the Fed lowers rates, like they just did, what it's designed to do is to spur growth in the economy. If it's cheaper for businesses to take out a loan because interest rates are less, that's going to help fuel growth. It can help fuel growth in all kinds of things, everything from mortgages. In fact, just today I saw a headline, mortgage refinance applications spiked 60% week over week because the mortgage rate has trickled down just a tiny little bit, which actually I think they're burying the lead there, because the lead is it's expensive to refinance. And there's Americans who are so desperate to refinance from their unaffordable mortgage rate as it is, that they're still willing to refinance even with rates still well above 6%. But I digress. So in the lower interest rate environment, the goal is to spur economic growth, more borrowing activities, and that in turn can help provide a boost to the labor market and kind of stop the unemployment situation from getting worse. But the problem with lowering interest rates in any time period, but especially right now, is that it is inflationary. We saw this in the COVID years when the Fed kept talking about, oh, inflation's transitory. It's going to go back down. Things are going to normalize. And they were dead wrong. That never happened. So then they had to overcorrect. They had to raise rates very aggressively in 2022. And then here we are, fast forward 3 years, and the effects of inflation are still with us. They let inflation get too bad before they started lowering rates, and those prices aren't going to come back down. They may stop getting worse, or the rate of price increases may stop being so bad. We're not at 9% inflation anymore, but the 9% inflation that led to the insane prices of pretty much everything are still with us today. Those do not go back down. They just stop getting worse. So now that we've laid the groundwork for this, I want to talk about what that means for you as an investor, if you're getting close to retirement, if you're living in retirement. And I want to start by talking about bonds. So when interest rates are falling, you have, especially at the short end, like money market, short-term bonds, they kind of lose their appeal. Maybe a money market, actually a year ago, money markets were paying close to 4.5%. Short-term CDs, same thing. About you could get actually 5% on a CD. I had lots of CDs I was buying at 5%, which is great. But when rates come down, those rates on especially shorter term money markets, savings accounts, CDs, those all begin to lose their appeal and the rates will come down even more. So I won't be surprised if money markets dip below 3%. Now, this is a topic for another day, but if the economy holds fairly steady and we're kind of in this slow growth environment, but we don't slip into a recession, I would fully expect that rates aren't going to go back. You can still earn maybe 2-3% on your money market. I don't think rates are going back to zero like they were in the 2010s time period, but the rates are coming down. So, what I'm doing for many of my clients and what I think is wise in general, unless you need the cash and the liquidity and you need funds for emergencies. But beyond that, if you're looking at longer term investment and utilizing your bond portfolio for that, you want to look at bonds maturing generally in the 3 to 7 year time frame. The reason is because you can lock in rates for a bit longer, but you're not going so far out in terms of, buying a bond that matures in 10 or 12 years where you're introducing another layer of risk in the duration of the bond. And something that can happen a lot of time, even when the Fed is lowering rates, is that you can actually see rates go up further out, which in turn would drive the value of that bond portfolio down on the longer end. And that's if concerns about the rate cuts spiking inflation cause people, basically investors, to demand a higher rate because they're concerned about longer term. What are rates going to be? What's inflation look like? I'm going to demand more money on my bonds if I think this is going to be inflationary. And so you might see a disconnect there between longer term, like a 10-year bond rate going up, even if rates are coming down. So you want to be careful about reaching too far out. Longer term bonds, again, could actually suffer and lose value. You could see rates go up, which means bond prices go down if inflation or the fears of inflation are kind of the undercurrent of the rate cuts, which I think that they are, because in this environment, you have tariffs that are still not fully priced into the system that can still be inflationary. You have inflation that is still hovering around 3%. So the interest rate environment that we've been in has not squashed inflation completely. So there is a risk that, you could have inflation pick up with the lowering of interest rates. I think that's a real possibility, and not just a possibility, but likely. So you want to stick with quality. In addition to paying attention and being careful about the time frame and the years, how far out you go, quality matters maybe more than ever. You want to stick with investment grade bonds. And I would also consider adding some inflation protected bonds as a hedge if inflation spikes. We've been doing this across the board in our own client portfolios. TIPS, or Treasury Inflation Protection Securities. There's a number of ways to invest in those. They're a great hedge, especially if inflation ends up being a little bit higher, especially more than expectations. While I wouldn't put your whole portfolio, your bond portfolio, into TIPS or the Treasury Inflation Protection Securities, a portion or a sleeve of that can provide a nice hedge. That's, I think, the prudent way to position a bond portfolio in this current environment. Okay, so moving on to stocks. Lower interest rates are generally good for stocks in the short term. It helps valuations improve. Markets definitely like when the Fed is lowering rates. It helps profit margins, but the longer term picture here is a lot cloudier. If the economy continues to slow or if stagflation actually comes to fruition, that's going to be a drag on stocks. So again, I would focus on, similar to bonds, focus on quality, the companies that are not the most overvalued. And the problem with the overall stock market right now is that if you look at the S&P 500, most of the companies in there have very little weighting. It's only a handful, like 10 companies. that are responsible for like a third of the weight of the index and the lion's share of the returns that we've seen this year. So make sure you're diversified. That's very important right now, especially because the US stock market is more concentrated than it has ever been. And when you couple that with the fact that the market is basically at its peak right now, but there's a lot of uncertainty and the possibility that the economy is headed for tough times, you got to be careful about stocks. But again, I think the lowering of the interest rate can be a little boost to stocks in the short term. Looking out more than a few months, though, I think it's very difficult to project. So, related to that is international stocks. Now, if you've been diversified outside of the United States this year, you are a happy camper because the dollar has been weak and there are lots of factors that influence how international stocks perform for US investors. But if you overlay a chart of the dollar versus other currencies, an international portfolio of stocks, they move pretty well in line with each other. So the weaker dollar, as long as the dollar is expected to remain weaker, which in this potentially inflation environment, I think is a distinct possibility. I think international stocks can continue to perform well. But again, there are risks with that. The geopolitical environment, there's uptick in conflict around the world. And, we have what's going on in Russia, Ukraine. We have what's going on in Israel, Gaza, conflicts all around the world, which is nothing new, but the risks are still high. So you want to be careful about where you invest and not have too much overseas either. I'm generally not changing my positioning in international markets or what I recommend for clients. Most investors, you can keep about, 20 to 25% of your stock portfolio overseas is a good place to be. Now, interestingly enough, if you own a lot of large multinational companies, which a lot of the biggest US publicly traded companies are, if they get a lot of their revenues from overseas, you could actually have a lower allocation to international because you're getting that benefit of international exposure even by owning a US based company. So you want to have enough, though, outside of the United States for diversification. But again, the US is the most stable, liquid, investor friendly market in the world. And it's also easier to understand the US market. So you want to have the bulk of your stock portfolio in the US, but you want to make sure you're diversified internationally. And a lot of investors have shunned international markets and they are underweighted international relative to US stocks because the US market has been the best place to invest. And your portfolio has done a lot better by being more US centric. But that's not been the case in 2025. And if the weaker dollar holds true, I think you're going to see international continue to do well relative to US stocks. Now, keep in mind, if the US economy goes into a recession, there's an old adage that maybe you've heard this: if the US catches a cold, the rest of the world's economy catches the flu. So if you go back and you look like how did international stocks do coming out of the great financial crisis in 08, 09, absolutely dismal. International stocks, like you were underwater for years after 2008, 2009. So you just don't want to be overly exposed. It's a nice diversifier. And, I think as long as the economy remains stable and we don't go into recession, I think international can do okay and it warrants a meaningful allocation in your portfolio. Okay, let's talk a little bit about real estate now. Not necessarily as an investment, but with mortgage rates and homes. Even though the Fed just cut rates and mortgage rates have actually started to come down already, I wouldn't expect a big sudden drop in mortgages. Rates are going to have to come down substantially. And the truth is that the US Treasury, the US 10-year Treasury, not what the Fed is doing with lowering or raising rates at the very short end, but it's the 10-year Treasury that more than anything dictates what mortgage rates are going to be. The spread can vary, but let's say if The US Treasury is at 10-year Treasury is at 4%, maybe rates are at 6%. So the 10-year Treasury would have to come down to say 3% or 2.5% in order for people to really salivate at mortgage rates. Mortgage rates are not going to go down to 4 or 5 or even 5.5% unless you see a bigger drop in the 10-year Treasury. And as long as inflation expectations remain higher, I think the US Treasury at the 10-year Treasury is going to remain elevated. Again, rates have already come down a little bit, but they could go higher. Mortgage rates could go up again if those long-term inflation fears go up. Now, the other thing I think is trending with housing is you're already seeing this. I see it in my local market, but I also read about it and hear about it in markets all across the United States, is that housing prices are coming down and they're expected to continue lower. And if the unemployment situation continues on the path that it's on, I think you're going to see housing prices continue to fall further because right now, I mentioned earlier, the average American is not doing well financially. There's a lot of signs that Americans are stressed. They're using the buy now, pay later to pay for groceries. There's car loan delinquencies, the effects of higher prices and inflation and everything going up. I just got an email yesterday saying my health insurance is going up 27%. Thank you very much. It's already way too high. Seriously, 27%? It's insane. And this is happening in all different kinds of expenses, groceries, gas is up. I mean, it's not good. The average American is not doing well. And it's the large companies, it's the people at the top of the income scale who have kept the economy afloat. But a huge percentage of the US population is not doing well financially, but at least they still have their job. So if the job situation gets worse, I think you're going to see a much bigger drop in housing, maybe 5, 10, 15%, in more than that in some markets. If housing activity picks up because now people are getting off the sidelines, if mortgage rates come down a little bit more, closer to 6% or into the 5.8 range, I think a lot of people would look at that and say, but if the unemployment situation gets worse, people are not going to want to lock themselves into a 6% mortgage, no matter what the circumstance, if they're worried about their job. And I think you're going to see more of that become a theme as we close out this year and into next year. So housing prices, the bottom line there with housing, I think housing can continue to soften and get worse. If you are wanting to sell your house, I think you're going to have to detach yourself from the value that it was at the peak in 2021, 2022, and come back down to reality. If you're looking to buy a house and you have a very stable job and you're not anxious about that, then maybe finally housing prices are going to come back down to an more affordable level, coupled with more affordable mortgage rates. And that could be something for a select number of people who are looking to buy a house or looking to upgrade their house. I think there could be some opportunities in the housing market. So be patient. I think housing prices are poised to drop further from here, and we shall see. I'll put my crystal ball away now. Okay, finally, I want to talk about gold and Bitcoin. Gold has been thriving this year. It has a long track record as a safe haven. So even though the economy has been chugging along, gold has been popular this year. The price has gone up for a number of reasons. I think a lot of it is the geopolitical uncertainty, but a lot of it too is just the weaker dollar as well. So gold does well when the dollar is not doing well. Gold also does well in times of uncertainty. So I think it could continue to do well. Even though it's had a big run up, I think gold could still do well from here. I've talked about this before on the podcast. I'm not a big fan of gold. It doesn't provide any income. You really have to, again, get out your crystal ball and figure out where the economy and the markets are heading. It tends to do best when everything else is doing not great. So it's a good diversifier in that regard. But If the economy is growing and the stock market is growing 70% of the time in general, gold just has long time periods where it doesn't do well. Okay, which brings me to Bitcoin. Well, Bitcoin, I also am not a big fan of. Obviously, lots of people have made lots of money in Bitcoin depending on when you bought and how it's done in the last couple of years. But my problem with Bitcoin in times of uncertainty is it does not have the history, it doesn't have the track record. You don't know how it's going to truly perform in economic cycles. Now, it has been around for several years at this point, I'll give it that, but it has not been through a big downturn in the market, except for during COVID, but that was very short lived. The ownership of Bitcoin today versus pre COVID, I mean, there's tons more people who own Bitcoin and other cryptocurrencies today versus 5 or 10 years ago. Also, the volume and the number of people who are trading and owning Bitcoin has completely changed. So, we just don't have a historical track record to see how it performs in different economic cycles. And I would be very cautious about investing in Bitcoin in times of economic uncertainty. Anybody tells you it's a safe haven asset, they're absolutely lying to you because there is no track record to back up that statement at all. Okay, so where does this leave us? Well, the Fed has started to cut rates. They've forecasted that they're going to continue on that path, but that path is full of uncertainty. So for investors, for retirees, people approaching retirement, I don't think much has changed. You got to stay disciplined. You have to stay diversified. You want to focus on quality, both in the stocks that you own and the bonds that you own. And if you have a lot of cash or money market sitting where you've been enjoying like your 4.5% return in your short-term CDs or money markets, I think that that's going to go away. So I would move to lock in rates in a more reasonable time frame where you can kind of clip coupons and collect a more reliable income stream for a longer period of time. Okay, build your investment strategy on a rock. We don't need to move and bend to the winds of the day, but we want to position tactically for whatever situation is coming next. If that's continued growth, stagflation, recession, I don't know, and nobody else does either. So we want to make sure we're preparing our portfolios for a variety of circumstances. And hopefully I've given you some more clarity about how to do that now that we're in this time period of a reduction in interest rates by the Fed. All right, I'm Ashley Mitchkay. Thank you so much for listening. If you found this helpful, please share it with someone who's thinking about retirement, and I'll be back with you with new episodes next Monday.